Hello, this is Gary Sherman of Whaddadunce.com. We put together a series on valuation basics, and this set of slides will serve as an introduction to that series. We're going to start this series by talking about the efficient market hypothesis. Now, when I went to grad school, before I went to grad school, I was in the accounting world. I worked for Deloitte. And then I decided that accounting wasn't my thing. It was a great background to have, but it wasn't my thing. So I went to grad school for economics, and then took the CFA exam and passed it. And so my idea is that I would go through grad school, pass the CFA exam, and then do my Wall Street gigs. And my theory is, and I was probably totally naive, but my theory is that whatever I was taught in grad school, once I got out into the real world, into the Wall Street world, that Wall Street would basically take everything that's taught in grad school and apply it. Well, that turned out to be totally not true. It was shocking. Like I said, I was probably naive, but it was shocking. What I found out is what's actually practiced on Wall Street has nothing to do or little to do with actually applying what they teach you in graduate studies on finance or economics. So here we have what we're going to do is we're going to develop these slides section by section, where we want to build a model from the ground up to value Costco shares. And our idea here is we want to determine what the shares should sell at versus what they're selling at now. So therefore, we can make a judgment call as far as is Costco shares, are they overvalued, fairly valued, or undervalued? So we want to make that call, but what we're going to do is we're going to build a model from the ground up using some rational thoughts as far as building this model so it makes sense. So at the end of the day, we're going to come up with the intrinsic value of Costco shares and then compare it to the market value. But before that, we have to talk about the efficient market hypothesis. And if we read that definition at the middle of the slide, the efficient market hypothesis is a financial theory asserting that asset prices reflect all available information, making it impossible to consistently beat the market on a risk-adjusted basis. And that was proposed by economist Eugene Fama in the 1960s. So it's been around for quite a while, and it forms the foundational logic for passive investment. Passive investment strategies are basically I have $10,000 and I want to give it to my money manager, and I tell him or her that I want him to have a strategy that replicates the let's say the some kind of index. It could be the S&P 500, could be the Russell, could be something that's more restrictive. So let's say we have an index that I want the money manager to replicate. That's basically it's going to be 10% Microsoft, 15% Intel, and so forth and so on. So really, what that money manager does is whenever I give him my $10,000, he says, well, 10% of the index is Microsoft. So therefore, I'm going to take 10% of your $10,000 or 1,000 and buy Microsoft shares and buy and hold. Same thing with Intel. I'm going to take 15% of my $10,000 or 1,500, and I'm going to buy Intel shares and buy and hold. So what I'm doing is I'm just replicating the index. I could care less as a money manager whether the shares are overvalued or undervalued, because that's not my problem, and that's not what passive investing says. But one thing that the efficient market hypothesis says is that bubbles do not exist. Bubbles are incompatible with that theory. So in other words, in a bubble, I have stock prices which are elevated over their intrinsic value, and the efficient markets hypothesis says that's impossible because stocks are fairly valued at any given point in time. So you can imagine the chagrin of a few of my classmates in grad school wanted to be stockbrokers or wanted to be in that business. And the efficient market theory says is that if you're a stock picker, you're basically wasting your time because the posted value or the price of the share is the value of the share. So therefore, if you want to go, on your way to building these models to say, well, what's the value of the share? You're wasting your time because the value of the share is what the market says at any point in time. So needless to say, right from day one, they're kind of put off by the efficient market theory. So what do we do with that efficient market hypothesis? Do we reject it? Do we accept it lock, stock, and barrel? What we're going to do is something different. We're going to say that the efficient market hypothesis is mean reverting in that over the long term, the hypothesis holds, but in the short term, we're going to allow for bubbles, periods of overvaluation, followed by periods of undervaluation, such that we have the mean where you have this mean line where stocks are fairly valued, but in the short term, we're going to have bubbles, and then we can have the opposite of that. Um, so what we want to do is take a look at that Costco share price, which is earnings per share times a PE ratio. We have $18.24 is the earnings per share. That comes from the financial statements. And then we have a PE ratio that comes from God knows where. In this case, in order to make the stock price work, we take the earnings per share of 1824 times a PE of 52. And the question is where did that come from? Does that even make sense? So like I said, we're going to develop the models and we're going to do things differently. What I found is that rather than using this kind of simple, unrealistic model where we take share price is equal to earnings per share times the PE, and what we're going to use is we're going to use bond math and apply that to value and equities. And what I found on the street is that the bond guys, those were the smart guys. Not the equity guys. The bond guys were the guys that were into bond derivatives, and they were the guys that pretty much were the smartest guys in the room. The equity guys, not so much. So what we're going to do is we're going to use bond math and apply that to value and equities. So at the end of the day, after we get through all of our slides, where we start with value in a term bond, and then say we're going to value a perpetual bond, and then we're going to apply bond math to value in equities. At the end of the day, what we want to do is we want to build a model to value Costco shares, and then compare that share price that we get from our model to the actual value of the share to basically answer a question: should I buy Costco, or should I do the opposite and short it? Or should I just do a if it's fairly valued, I'm just going to basically do nothing and continue to hold the stock. So what we want to do at the end of the day is we want to apply bond math to value in equities rather than using that simplistic earnings per share times PE ratio. So in part one of the series, we're going to value a term bond. And a term bond pays interest, which are coupon payments, over the bond term, and then pays the face value at the end of the bond term. So we're going to build a model that values a term bond. And then we're going to make another assumption in part two. We're going to value a perpetual bond. With a term bond, you make coupon payments followed by a payment of the face value. But if for a perpetual bond, the term is infinite. So you never get your principal back, but we're going to allow the term bond to grow. And so that as the term bond or as the perpetual bond grows, the coupon payments also grow. So we're going to value that perpetual bond, and then we're going to realize that if we look at the math of valuing a perpetual bond, it's very similar to value in equities. With a perpetual bond, we assume that we have a cash flow coupon payments that go into perpetuity, and the same thing is true with an equity. We have dividend payments that go into perpetuity. So what we're going to do is we're going to take the part two value in a perpetual bond and apply that math to value in common stock. And then in part four, what we're going to do is we're going to take what we've learned in part three, which was value in equities. We're going to use bond math to value equities. We're going to actually apply that to valuing the share price of Costco. So why are we doing all of this? This is all about financial literacy. Um, I had, you know, I've had people say some pretty dumb things to me, over my career. One of them was I was giving a lecture on Monte Carlo simulation, and at the end of the lecture, a guy comes up and says, "You know what? At the end of the day, I just want a button I can push. Forget the theory. I just want a button I can push. Yeah, idiotic statement number one. Another thing is that if I look at share price, if the shares sell at $20 a share, that's pretty cheap. If they sell at $40 a share, that's kind of what I expect. But anything over and above that is just too rich. That's also something that is totally untrue. So what we want to do is that we want to come up with a rational method of valuing common stock. And to do that, we're going to use a lot of math. So for those of you, and I'm sure there's a lot of you who are afraid of math, I love math. I mean, that's my thing. So we're going to do a lot of math, but the thing is you don't have to go through the math on your own. You can look at the slides and see how these things are built, see how these things are thought out, and then take the end result as your equation and know that there's some fundamentals to that. Now, one of the problems with doing the math is that there's nothing out there that makes my job easier. So in other words, if I had to value a common stock of Costco, which I'm going to do here, I'm going to have to go out and get all the annual reports for Costco. I'm going to have to take a look at all a whole ton of ratios. I'm going to have to build my model, and I'm going to have to take a look at a lot of time series data, historical time series data for the market in general in order to build my model assumptions. And I'm going to have to, not only that, I'm going to have to build my model itself using a lot of the math. Now, we're going to do all of that here. But the nice thing about the software that we developed is all that's done for you. Now you still have to come to a conclusion on valuing the share price. Anyways, we have right now we have about 100 S&P 500 companies in the software. And that's going to grow over time. Probably that'll incorporate all the S&P 500 companies and some of the companies that aren't S&P and some of the companies in the Russell. So the idea here is to create a community where we can all learn from one another, where all of these ratios and everything I need to calculate the value of a common share is there. But it's up to me as an analyst, and it's up to you as an analyst to use that data in a rational way, using the models that we provide to come up with what you think is the value of the common share of, in this case, is going to be Costco. And one thing I've learned early on from my Wall Street experience is that you are on your own. You can't ask your stockbroker for, what should I do? Because at the end of the day, they're just going to spit out a narrative. Um, no one's going to bail you out. If you're head of your household and you do the finances, then it's up to you to provide for your financial future, retirement, etc. So if you blow it, that's on you because no one's going to bail you out. So, like I said, one of the things I've learned early on is there's no one to blame but you, and you are responsible for making your investments. And if you do something stupid, hey, that's on you. No one's going to bail you out. So the reason why we built the software is for financial literacy, so that we can all learn from one another. So we're going to have this community of investors all using the same models. Some people, like my expertise is primarily in banking and financial services. We're going to have other people on the site who are, their interest might be in mining and extracting mineral resources. Some other people might be, experts in tech. So we're going to basically take all these people, all these members of our community, and we're going to learn together so that we don't do stupid things. So what we want to do right now is that the software is in the state of being beta tested. So what we want to do is we want to get 100 users onto the software to provide feedback. to build our community. And then we're going to offer it to the public at large. But as compensation to those 100 people who volunteer to be the guinea pigs, the software will be free for life. So what does the software do? We provide valuation models based on the industry. Currently, there are three base models and five industries. We have 100 S&P 500 companies that will grow over time. We provide all the historical financial statements, balance sheet, income statement, ratios, and we provide all the notes to the financial statements too. And we get the notes from what's called XBRL, which was a pretty cool idea of the SEC to require public companies to have a standard reporting format that you can electronically extract data from. We also have time series data. For example, S&P 500 returns over 100 years, GDP, bank charge-offs, bond yields. So we have 70 plus time series and growing. We also have the ability to export financial data. We have model charts and graphs by category. So we have graphs. So in other words, you go through this estimation of share price, and then you could look at it graphically to say basically say, what am I saying as far as revenue growth, return on assets, net income, and all that kind of stuff. Ability to work in groups. This is important. If you have an investment group that you want to basically come onto the software, it'll allow you guys to, let's say you have three or four of you, to actually work in a group on valuing the companies that you choose. Basically, we have a library of 100 companies, and you just pick one from the library and just value it, and go through that valuation process. We have messaging to and from group members. We're going to have discussion forums, and the software is written in C# with a SQL backend. So come join our community. And with that said, we will start the process of working through the sections on valuation basics with the goal of producing financial valuation models that are rational and make sense. And then we're going to apply it to value and Costco.